Another episode of Equity Mates here at AusBiz. My name is Bryce, and as always, I'm joined by my equity buddy Ren. How are you going?
I'm very good, Bryce. Very excited for this second of this four-part series this week. We've got Michael Frazis from Frazis Capital Partners joining us. We spoke in yesterday's episode about the pretty phenomenal FY21 he had, 93% net of fees.
I'd love to say it.
You wouldn't turn your nose up at that. In today's episode, we're going to go a bit deeper on, I guess, Michael's process and how he looks for some of these companies that have just done phenomenally well.
Absolutely. Well, it's our pleasure to welcome back to Equity Mates on AusBiz, Michael Frazis. Michael, welcome.
Thank you. It's great to be back.
So, as Ren introed, you clearly have a knack for picking those companies that are in that hyper growth stage and just pumping out incredible results. No doubt that you will have some in your portfolio at the moment, but let's start at the top. We obviously are constantly searching for companies that are going to be compounding at huge multiples and becoming those 100 baggers. Where do you start when it comes to trying to find companies like this?
Look, for us, the starting point is always execution, like which companies are growing. If you're actually looking for 10 baggers, and I don't think anybody really starts by doing that, but if that was your goal, like I want to get a 10 bagger, or I want to get, something goes up 20 or 30 times, you're going to have a company that increases, in value by 20, 30. It's going to have to increase in size by 20 or 30 times. And to do that, it's going to have to grow. And, growth means different things to a lot of different people. A 20% growth rate to a lot of growth managers is pretty good. I think if you actually want to get those stellar returns, you really want companies that can grow at 50 to 100%, ideally over 100% year after year after year. And effectively, if you look at something like Afterpay, or there's countless other examples, companies like Mercado Libre, Tesla, the top software companies, they just maintained exceptional growth rates for 4 or 5 years. And then you landed at somewhere materially different to when you started. So for us, the starting point is always organic growth rate. How fast are they adding users? How much more is each user spending? And how fast are those revenues? How fast are those actual dollars that are going into that company? How fast are they growing? And we start there.
I just want to pick up on something you said there, Michael, about organic growth rate. Obviously a lot of companies can see great growth from bolting on companies and, an acquisition strategy. Do you discard that when you're looking? Are you purely looking at the organic growth rate for companies?
We always discard that. Yeah, the best companies, they grow internally, they grow organically. All of our best returning companies, they've done it organically. And the reality is the incentives around acquisition are very not necessarily investor friendly. So if you manage a company and your CEO, one of the smartest things you can do is issue a bunch of stock, buy another company and double in size. You get paid twice as much, you're running twice as many people. It's much more exciting, much more glamorous. Every CEO wants to be CEO of a bigger company, and it's very easy once you've got that currency and you've got that hands on the steering wheel and on the levers to issue stock and then buy something else. But for us, or for investors, for everybody listening to this, your return's $1 per share. So if you dilute a bunch and then you buy a company that's not very effective, and that's before considering the fact that, management generally, because they've got these incentives to do it, all things equal, they'll do bad deals. The incentives are such that they'll often be over optimistic, and everybody around them will be the same. So the accountants, the lawyers, the investment bankers, everybody's incentivized to do deals and to have a bigger company that's higher fees for everybody. And this isn't bad. I mean, everyone's just doing their job, but it's important to recognize those incentives. And I think that is one of the reasons why typically these roll-ups, these aggressive acquirers generally don't do so well. And it's not clear to me, they rarely end well as well. So you see companies that do it for 5, 10, 15 years, but then everybody involved in the company, the CEO, the advisors, the executive team, they just want to do bigger and bigger deals. Until eventually they do something that's too big, and that ends up being their undoing. So it's not really what we're about. It's not what the best companies are about. You want companies that have a product or a service that's probably pretty simple, that people clearly love, and people are using more and more and more of. Like that's the kind of profile that you want.
So you find, say you come across a company, you're looking for it to be growing 50 to 100% year on year. It's in America and it's delivering quarterly earnings, which is growing 25% or so. How long do you wait to actually decide when to get into the company? Like if you saw a company that was pumping out 50%, do you wait 2 or 3 years, or what's the process between seeing the growth and then getting in?
Yeah, well, the beauty for us is we specialize in this. This is all we do. We just do fast-growing companies. So when we see one, there's a good chance we've seen a bunch of other ones like it. We probably know equivalent companies in other sectors. We can usually come to pretty quick decisions. So earnings is often the wrong metric because the best companies are spending, they're investing to get that growth, and the best returning companies often don't show earnings for a very long period of time. So we'll move pretty quick, but it's very telling once you think something's really good, what the next result does. Once you see that kind of live action, like you kind of make a prediction, then you get it seen in the market. And so often we'll take small positions and really build as those quarterly results come through, and it becomes clearer and clearer that the company is in fact a monster and is actually going to go on to do phenomenal things. And I'd say that every company that has worked for us, every single quarter, stock's been volatile, they might hit or miss versus expectations, but they were bigger every single quarter. They delivered every single quarter. They had more users, more revenues. And that's, having seen that so many times, that's the profile we want to see. But there's a couple of other things. I mean, the trap for this stuff is you can spend to get growth. You can spend too much. You can also effectively, the classic thing, if any company in the world can grow, if they cut their prices by 50% or to the point where they're losing money, generally will just take market share from everybody else. You want to avoid those traps. I think the most common one is actually companies spending too much to grow. And so an example of that what's the name of it? It's annoying. I can't remember the name of it off the top of my head. It was growing at 90%. We actually bought it. We're pretty excited. It doubled. And then they did a result where they spent 120% of their revenue on costs. They spent every dollar of revenue they got that quarter they spent, and they only grew a little bit on the quarter on quarter. So always very closely looking at that quarter on quarter, like how much bigger today is it than 3 months ago? And more importantly, how much do they spend to get that? And if they're spending a phenomenal amount to get a very small amount of incremental growth, that might be the only clue that you get that things are changing. So we're very aware of those kinds of clues. Similarly, we're very focused on web traffic, third-party data, anything we can do to app data, anything we can do to assess how they're going in real time. There's a lot of sources like that. Again, when the growth slows down, when there's problems, often there will be a clue, but often there'll just be a few difficult to see clues amidst the noise. And the longer we're in this game, the more you kind of really pay attention to those when you see them. Is that helpful? Does that answer the question?
Yeah, absolutely.
So Michael, you mentioned there, it sounds like you're very numbers focused. You're looking at those quarterly results and you're looking at, revenue growth. You mentioned earnings growth, not as important. Companies, when they're in that hyper growth stage, don't need, to be showing profit at that point. You mentioned some other sources of data like web traffic, app usage, stuff like that. I guess if you take a step back and you found a number of potential investments, and now you and your analysts are working to form a thesis, what other sort of forms of research are you doing to really get a holistic view of these companies and really understand them?
Look, we'll speak to employees, customers, we'll get a feel for the product. I think all the best returning companies have been doing something special. They've generally been category creators, leaders, the Shopify's, Afterpay, Tesla, or these number one e-commerce providers in certain different areas. They've always got this X factor. They're always really exciting. You want to be a part of them, in some tiny way. And that's, when we talk about a strategy, we say it's like explosive growth and true customer love. And you want to see that like X factor as well. And we try not to buy things unless they have that, because it's just so important. And it really makes a difference as to something that is just a one-hit wonder, or something that can sustain something for growth for many years. So that's another thing we look for. And I think anyone listening to this podcast can probably get a feel for that. Like you probably feel different when you open an Apple device than when you open, I don't know, on a Lenovo computer or something. They feel different. Like one of them has an emotional impact and one doesn't. And the more you can kind of see that emotional impact, the better, I think.
That's because all Lenovo computers are given out by corporates, and everyone is probably used to opening Lenovo's in their corporate jobs rather than at home. But anyway, to close out today's episode, Michael, you buy into a position, it's getting phenomenal growth, pumping out 50, 100% plus year on year, and then it might start to slow. Where do you then draw the line when it comes to knowing when to sell? What are some of the indicators you're looking for? I mean, I imagine that if it's giving 20% returns, it's no longer good enough for the portfolio. So how do you know when to get rid of them?
Yeah, look, it's really simple for us. A lot of people talk about the process. We actually have like a pretty well-defined one. So we just look at the numbers and we'll hold it as long as it's executing. Often we get that wrong. So an example is Xero. So Xero had that true customer love. Accountants loved it. They basically invented the kind of cloud accounting. If they went into the US earlier, they'd probably be worth, many times more than they are today. They still did outstandingly well. They kind of slowed from that 60, 70% growth rate down to 50%, down to kind of 30%. And that's when we sold. But funnily enough, that's when they started making real cash flows and real profits. And they went from being this hyper risky stock that nobody wanted to touch to something all the institutions wanted to kind of like anchor their portfolios with. And so the multiple actually expanded as they slowed down. I've seen that a few times. We did something similar with Apple. We actually sold in 2018, and we're thinking, smartphones are saturated, and they were. Smartphones were flat over the following 2-3 years, but the multiple doubled, and they were able to buy back shares, and so we'll often sell to kind of people that are much more willing to invest in 20-30% profitable growers. We'll kind of catch them when they're growing at 100-150% and not making money, then pass them on. But that doesn't mean that's the end of the story. And people can do very well, buying and taking them further. But, the real answer is every result, we'll review the numbers. Is it growing? Is there evidence that it's doing something special? Do customers still love it? And anything that doesn't fit that characteristic, we will sell and not really think twice about it. And that's the advantage of having 40 stocks as well, by the way. It really makes that decision-making process really simple. And one other thing, I guess the ones that worked, like I said, they delivered every quarter. You got the quality results, like, it's 20% bigger again, than it was 3 months ago. And it just happens and they can maintain that for 5-6 years. And they've been the best performers. I think it's something to watch out for as well.
Well, Michael, that does bring us to the end of today's episode. Unfortunately, we have run out of time, but plenty of great takeaways there for the Equity Mates community and the AusBiz community, and on some key metrics, I guess, to look out for when trying to find that next 100 bagger. So very much appreciate your time. And tomorrow we will be back looking at 3 stocks on your watch list, and very much excited for that one. So we'll see you tomorrow.
Great. Thanks so much, Alec and Brian. Appreciate it.
And that brings us to the end of today's episode. As we said, we've got Watchlist Wednesday with Michael tomorrow. Can't wait for that because I'm sure there's going to be some crackers.
Yeah, it should be good. So join us, same time, same place, and we'll pick it up with Michael tomorrow.